We definitely had some market moving events last week, to say the least. President Trump won the election on Tuesday, and when the markets opened on Wednesday morning, we saw a huge rally in the stock market. The Dow Jones Industrial Average was up over 1,500 points. This pulled money out of bonds, and in turn, mortgage bonds lost 21 basis points, which pushed rates up. We did end up recovering on Thursday and Friday, and we closed out the week better by approximately a quarter in rate. According to Mortgage News Daily's rate index, the 30-year conforming fixed rate was sitting at 6.92% as of Friday, November the 8th. We also got the results of the two-day Federal Reserve meeting last Thursday, where the Fed announced a quarter rate cut to their Fed funds rate. This was no surprise to the markets as they had priced in a 99% likelihood of this amount. I've talked a lot in my previous videos about how important inflation is as it relates to long-term mortgage interest rates, specifically the core personal consumption expenditure number, which strips out volatile food and energy prices. This is the Fed's favorite measure of inflation, and they want to get this number down to their target rate of 2%. As of September's reading, the core PCE is sitting at 2.7% year over year. Listen to what Fed President Powell had to say about his short-term outlook on core inflation.
We really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation.
He's describing how the month-over-month numbers were very, very low last year in October, November, and December. And because of this, he's expecting that the core inflation reading will remain stubbornly higher for the next 3 months. You can see here in this chart that in October of last year, the core month-over-month reading was at 0.133%. In November, it was at 0.091%. And in December, it was at 0.182%. The 2024 replacement values will be higher, which will move the 12-month calculation up. But once we get to the January report, which is released in February, we will see core inflation numbers coming down because we will be replacing this very high 0.498% number. This is one of the main reasons I believe we'll see better mortgage rates starting February of 2025. Check out President Powell describing where today's inflation is coming from and the lag effect in housing. This is going to be the key to lower mortgage interest rates in the future.
What is the inflation story now? Where's it coming from? Non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are, market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures.
He's explaining that new leases are not experiencing upward pricing pressure like we saw in the past. But because leases typically lock in a tenant for a 12-month period, it's taking some time for those older leases to get to their renewal dates. This is the lag effect he's speaking about. If you look at real-time rents via apartmentlist.com, you can see that in September, rents were actually down negative 0.7% year over year. Compare this to the PCE's positive 4.9% housing inflation reading, and you can see the big discrepancy between the two, and hence this lag effect. On a side note, the housing category is the biggest and heaviest weighted component of the core PCE number. It represents approximately 20% of the overall inflation number. As this part continues to catch up, inflation will continue to go down towards that 2% target rate that the Fed has set. This is the big reason why many market experts are predicting lower mortgage rates in the future. Remember, as inflation comes down, mortgage rates will follow. Inflation is and will continue to be the number one driver of rates. If you like this information and you want to stay up to date about mortgage rates, find me on YouTube and subscribe to my channel. And as always, let's get better, let's close more deals, and I'll see you in the next video.